The man who shorted the 2008 housing crisis, the investor from The Big Short, he's just vanished from public view. He's pulling the plug. Michael Burry is stepping away. My first thought was, what does he know that I don't? Welcome to DeepResearchGlobal.com podcast.
I'm an industry analyst here, and I am with my colleague. Today, we are breaking down what is probably the biggest piece of market news for investors right now. I'm talking about Michael Burry deregistering Scion Asset Management. And for me, this isn't some administrative change. It feels more like a declaration, a statement that he thinks the current market game is, well, rigged.
It is. It's a huge statement. And that's exactly what we need to figure out today. Our mission here is to explain what this deregistration means for you, the investor, because we just lost one of the most important contrarian voices out there. And more importantly, what is his final thesis, this massive accounting criticism of the AI giants? What does that imply for our holdings between, say, 2026 and 2028?
Okay, so let's start with the hard facts, the regulatory side of it. Scion Asset Management's registration with the SEC was officially terminated on November 10th, 2025. That's the action.
Right, and here's why that's a critical signal. It's not just paperwork. By law, if you manage over $100 million, you have to register and you have to file public reports, the famous 13 Fs we all watch.
Yeah, and Scion was managing about $155 million as of March. So by deregistering, he's no longer required to file anything with the SEC. Or any state. He's effectively gone dark.
The light just went out, so we've lost that data point. The consensus, though, is that this isn't him just quitting, is it?
No, not at all. This looks like a pivot to a family office setup. I mean, he's done this before. He's just going to run his own capital, operate completely off the grid for a while. He wants to move without a million people watching his every trade.
And his social media clues were pretty fascinating. He posted, "On to much better things, Nov 25th. But the one that really got me, the line that frames this whole thing was, sometimes the only winning move is not to play.
That's it. That's the core of it right there. He believes his estimation of value, and this is a quote, is not now in sync with the markets. He's saying the game is broken for a value investor.
And you can see why he'd feel that way. I mean, the market has become so hostile to anyone with a bearish view. You try to short one of these tech darlings in the last few years, you just get run over.
You get crushed. There's just this unfettered optimism around AI and tech and a flood of retail interest that doesn't really care about traditional valuation. The squeeze risk is just immense.
It feels tactical. And we've seen this play before, which is what should really give investors pause. He closed his original fund, Scion Capital, back in 2008, right after his big win.
Exactly. He made his call, he made his money, and he walked away from the public pressure.
Right.
This move, it mirrors that past withdrawal perfectly. He's telling us, if the market isn't based on reality, I'm just going to wait on the sidelines until it is.
So if he's leaving the stage, we have to treat his final words as his ultimate warning to us. And it's not just a feeling he has. He's pointing to specific numbers. His final piece of analysis before going dark was this huge criticism of the tech heavyweights, basically equating the AI surge to the dot-com bubble.
And this is where it gets really interesting, because he didn't just yell about a bubble. He pointed directly at the accounting. His specific accusation is that major cloud providers are using, let's say, aggressive accounting.
Okay, let's slow down here, because this is the critical part for investors. We know the big guys, Microsoft, Google, Oracle, Meta, are spending billions on NVIDIA chips and servers. That's a massive cost. So how does that become an accounting trick?
It's all about depreciation. It's how you account for an asset losing value over time. And here's the punchline. These companies are quietly stretching out the depreciation schedules for all that new AI hardware. It makes their earnings right now look way smoother and way higher than they actually are.
So an analogy for our listeners. If I buy a supercomputer, and normally it's obsolete in 3 years because tech moves so fast, what are they doing?
They're saying on the books, oh, this will be useful for 7 years or even longer. They're pretending that these servers in the fastest moving tech sector in history will have a much longer life than precedent suggests. So they're understating the true cost today.
Ah, okay. So the huge expense of the AI build-out is real, but they're spreading that hit to their profits over a much, much longer period. The problem is that cost is waiting down the road to hit the income statement.
Precisely. And Burry put a number on it. He wasn't just guessing. He estimated that between 2026 and 2028, these accounting choices could understate depreciation by about $176 billion.
$176 billion.
Right.
That's a staggering number. What does that actually mean for an investor looking at a PE ratio today?
It means the earnings might be inflated. That's not a rounding error. It's systemic. If you depreciated that spending realistically, that $176 billion could wipe out maybe 15 to 20% of the combined net income for those companies over that period. He's saying the profit picture in the late 2020s is much, much weaker than it looks today.
That is the core of his warning. And since we won't get any more of his filings, his last known bets are now incredibly valuable. Let's look at those.
Absolutely. He took huge leverage positions. First, NVIDIA. He bought put options covering 1 million shares. The notional value on that is about $186 million, a massive bet against the poster child of AI.
And the Palantir bet, that really shows his conviction through the leverage, doesn't it?
It really does. He spent just over $9 million on the options themselves. That's his cash on the line. But those options give him the right to sell 5 million shares at $50 a share. The total bet size, the notional exposure, is $250 million.
Wow. So less than $10 million to control a $250 million short position.
And get this, they don't expire until early 2027. This isn't a quick trade. It's a long-term strategic view.
He's confident time is on his side, and that this accounting reality has to catch up eventually. And finally, there's the persona, his social media profile. He calls himself Cassandra Unchained.
It's the perfect way to frame his exit, isn't it? Cassandra from Greek mythology, cursed to tell true prophecies that nobody believed.
Exactly, and she was ignored and Troy fell. So for him to lay out a $176 billion accounting risk and then adopt that name, he's essentially saying, I've told you, I've given you the numbers, now I'm done fighting the narrative.
The action of leaving speaks louder than any filing ever could. He's stepping out of the theater until the scene changes. He's betting on gravity.
So let's bring it back to you, the investor. What's the final takeaway here? First, we've lost a major contrarian voice. His exit suggests he believes that trying to be a public bear in this kind of frothy market is, well, just futile.
And second, and this is the actionable part, you need to seriously consider the $176 billion accounting risk he highlighted. If he's right about that depreciation stretch, then reported profits in the AI sector could face a major headwind come 2026 to 2028. This forces all of us to question the very foundation of current AI valuations.
Thank you for listening. Subscribe to deepresearchglobal.com for more latest business news briefs, company analysis, and investment insights.